For most people, graduation day feels like freedom until the student loan emails start coming in. If you're navigating life after college with student loan debt in tow, this episode is for you, so stick around.
The information presented on this program is believed to be factual and up to date at the time of its recording. We do not guarantee its accuracy, and it should not be regarded as a complete analysis of the topics covered. Discussions and answers to questions do not involve the rendering of investment advice, personalized or otherwise, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Measured Wealth Private Client Group is registered with the Securities and Exchange Commission and only transacts business in states in which it is registered or exempt from registration.
Welcome to Financial Futures, a Measured Wealth podcast powered by the team at Measured Wealth in beautiful Portsmouth, New Hampshire. Each episode, we're bringing you fresh insights on retirement, investing, and everything you need to take control of your financial future. Whether you're preparing for retirement or already living it, we're here to help you make informed choices with confidence. To kick off today's conversation, here's your host, certified financial planner and chartered financial analyst, George Zaharopoulos.
Hello, everyone. Today, I'm speaking with wealth advisor Joe Neff. In addition to being a certified financial planner, Joe is also a certified student loan professional. Joe, great to have you back. How are you?
I'm doing all right. It was
Awesome.
We had a fun party last night, right?
Yeah, that was great. So we actually just had our holiday party, we call it, right?
Yeah, annual holiday get-together. Yeah.
That was fun. So, Joe, tell us about your background and experience as it relates to student loan planning. Tell us about your certification or credential. What should people know about that?
Yeah, so my background with student loans is I graduated college with a lot of them.
Fortunately, I graduated a lot earlier without that type of student debt, so happy about that. But today's environment is totally different. So
Yeah. Yeah. Things have gotten pretty bad out there. No, when I graduated college, I had gone to a private school that doesn't take any federal funding. So federal student loans were not on the table. So I ended up with, on the worst possible side of things, I had all private debt. Right. And when we're talking about student loans, the first kind of differentiator is whether or not your loan debt is private or public. So, yeah, going through the process of digging, my wife and I digging ourselves out of that hole took a lot. And so I kind of picked up and ran with this, I guess, passion and overwhelming hate for student debt. So,
yeah, I mean, but the private versus public, you know, you're going into college. You don't really, do you have a choice? Can you really say, I want this much in private, this much in government debt or student aid or, you know?
You can, yeah. So if you, I mean, when I was in school, it was in the middle of the kind of tapering out of the financial crisis. Interest rates were at their absolute worst. So I didn't get a lot of options that way. But yeah, new borrowers can typically choose to, one, take the aid they're granted through the federal government, right? And if you don't have parents that are paying your way through college, usually the student debt is the only way to go unless you're really pedaling on the scholarships. You can take or leave any part of the offering in terms of what's granted to you through FAFSA.
All right, great. So what is the Certified Student Loan Professional designation? Can you expand on that a little bit?
Yeah, so the designation itself prepares a professional for working with individuals with, like I said, both private and public student loan debt. We're generally experts in the certain repayment plans allowed through the federal government, right? So that's kind of shrinking now, and we'll talk more about that in a little bit. But yeah, going through making sure that an individual has their entire student loan inventory together, and then helping them figure out the best way to pay those down or work towards eventual forgiveness, whether it be through the long-term plans like IBR or the new repayment assistance plan, or public service student loan forgiveness.
And this isn't really a specialty of a lot of advisors, right?
No, it's not really glamorous work, if you know what I mean, right? Usually people fighting with student loan debt are not rolling in the dough, so to speak.
But certainly a problem to solve. What is the state of the student loan marketplace out there today? So what are the choices? What are people graduating with debt? They're going into their early careers. What are their possible options? What's kind of the state of this environment right now?
The state of it is terrible, right? Mm-hmm. Right. So right now, a little over 1.8 trillion in student loan debt is held in the U.S. That's spread out between. I've got my cheat sheet here. That's spread out between, I think it's 45.2 million borrowers, and that's in the federal side. So there's going to be more over and above that on the private side as well. So it's huge, right? The cost of college is insane these days, and the prices have continued to go up. I mean, for the 2023 to 2024 academic year alone, parents and the students borrowed $99 billion just for that 1 year.
Is there more opportunity to restructure the private debt versus the government debt or public debt?
No, and I think before we talk about that, we need to talk about the difference in delinquency and default between the two.
Okay.
Right? So what we're seeing now, right, is this massive uptick in student loan delinquencies at the federal level because they're tracking that. And those have increased, I think, up to 12%. We were talking about it a little bit in the internal investment meeting we had here. One of the realities I think people miss on that is back in 2024, they released the Saving on a Valuable Education plan, or the SAVE plan. And looking at it back then, even before I was like deep in the student loan side of things, I looked at it and I said, this isn't sticking around. Mm-hmm. It was incredibly favorable to the borrower, which is they're good and bad to that, right? But there's just no way that was going to be able to pass. All of the provisions inside of it were going to be able to be worked through without some sort of legislation going through. So we carried on with that. We made hay while the sun shined, right? And a lot of people did a great job taking advantage of that plan because it was a 25-year forgiveness plan, right? And one of the bigger issues when you're on these income-driven plans is at the end of that 25 years, the entire forgiven amount, right, is taxable at regular income tax rates. Mm-hmm. So you go from, there's huge potential for you to go from owing a ton in student loans to now owing a more aggressive collector, the IRS, a huge note.
So if someone had their loans forgiven, they could get a 1099 and say, hey, this is ordinary income, this amount of forgiveness?
Yeah, both at the federal and state level.
Wow.
Yeah, it's a lot less glamorous than people think it is, right? But there's still useful options because up to this point, you were probably able to lower your monthly payment in a significant way that might have been able to allow you to do things like pay rent.
Mm-hmm. Right.
And eat.
That's important.
Yeah. And not eat cat food, right?
Right.
But on the backside of that, this whole time, you should be saving and investing for the sake of eventually paying that tax bomb back, right? And not a lot of people are doing that. Mm-hmm. And that's why you would look for somebody in the business of advising people through the student loan process to say, hey, this is how much you should be saving towards this per month. Because the power of compounding still exists, right? Even that invested amount is smaller usually than the difference you would have to pay if you were on, say, a standard repayment plan.
Mm-hmm. So that kind of was a little bit of history. Is that bringing us to today, or was that?
So there's a little bit more catch up there, right?
Okay.
So back in 2025, or the SAVE plan almost immediately started having issues on the legal side, but it was enjoined in July of 2024, right? Totally. So the people in the plan were put in what's called an administrative forbearance. So the loans weren't accruing interest then. It had quickly, and for good reason, become the most popular repayment plan out there because it had replaced the other more popular repayment plan out there, which was Repay. Mm-hmm. Just in favorability wise, these were good options, right? And then all of those borrowers were placed in administrative forbearance. So the government said, we're not letting you make payments. We're not counting anything towards your forgiveness, your eventual forgiveness, but we're also not going to charge you interest. roll forward to August of 2025, now these are again accruing interest. They're still not counting it towards payments, and they're not collecting money on it. So the loans in the background are still just building interest and interest and interest, and there are still 7 million borrowers on this plan. So they're not making payments. Their loans are accruing interest, and they're just waiting for the SAVE plan to eventually die, which they finally set a date for in 2028.
Any idea what that interest rate they're being assessed?
Depends on when you borrowed, right? So some of the older ones might have a lower rate, somewhere in the mid fives. If you went to grad school and you had some grad plus loans in there and you're on the SAVE plan, there's a good chance your rates are anywhere between 7 and 9%.
Has the maturity date expanded as well, or has that stayed the same? Meaning, if they restart their payments, will they be looking at a shorter amount of time for payback, which would increase their payment, or has that kind of been pushed out?
It has been pushed out, right? The reason for that being the kind of credits toward this eventual forgiveness don't accrue unless you make a monthly payment, right? So you're not talking in terms of years, you're talking in terms of credited months. And the same thing with public service student loan forgiveness, right? It takes 10 years or 120 credited months of working for a government or a non-qualifying nonprofit.
This is all really important to understand for those of our listeners out there who have student loan debt. This is really important. Joe, there's probably more you're going to expand on that, but if someone were to come to you, they showed you, all of the debt that they have, what's your approach to counseling them? What steps do you walk them through?
So my ideal is figuring out a way to get them done with student loan debt as fast as possible, right? Now, there are caveats to that, right? You think about kind of the more expensive professions to get into, your doctors and your lawyers, right? The longer you spend in school, the more compressed your savings and accumulation period is. So take, for example, somebody who goes through medical school, gets out, goes through a surgical residency. Those can take sometimes 7 years, right? So you're looking at starting your career, so to speak, at 33, 34. If you get into it later, I've seen docs graduate as late or finish residency as late as 40, 41. It all depends on the specialty, all depends on the fellowships, so on and so forth. So obviously it doesn't make sense to then say, let's just pile all of your money on your student loans, even though they make these massive incomes, hopefully, right? There's downward pressure all over the income map in terms of doctors. But hopefully they're making a great income. But each year, once you finish that residency, is precious because you've lost all of this time in the ability to compound the interest in your investments over the course of your life. So that compressed earnings time means we have to figure out a reasonable split between balancing what you have to pay out in student loan payments each month and then what you allocate to investments and how to structure that properly. And there's great parts there, right? I'm just going to stay on doctors for a little bit. So typically in a hospital, you'll have access to a 401k or a 403b, right? If you're working at a teaching hospital, typically for the higher income employees, and it's designed to help these doctors out, there'll also be a 457. Now, for each of those plans, right, because 403b and 401k, you get your $24,500 for 2026. And then if you just have access to those two, you can't do any more on the employee side. But with the 457 on top of, say, this 401k or 403b, you double up on those contributions. Now you're putting away $49,000 a year, right? And that goes in pre-tax. Each one of those $24,500 contributions, putting away for retirement, building that investment base so that it grows at a compounding rate over a period of time, while also reducing your adjusted gross income. And these income-driven repayment plans, we could talk for a long time about these, but these income-driven repayment plans, the actual income marker for the older repayment plans, so if you were a borrower before July 1st of this year, 2026, you still have access to IBR, and for a limited time, pay as you earn or pay. And then one other plan that we're not going to go into detail on, but the actual marker is driven off of discretionary income. So it's your AGI less the multiple of the federal poverty level, right? So if you have 4 or 5 kids, good for you, first of all. But also, you get this massive deduction off of your income already, lowered further by the investments there. So maybe you make $300K a year just out of residency, building up those RVUs, right? And now you're taking off 70-ish thousand in a federal poverty level deduction, minus another 49,000 in that 403B and 457 contribution. And then, hey, let's hit the HSA on top of that, right? For another 8,400, 8,500.
Lowering that number
Yeah.
helps lower the student payback amount, or the monthly or annual amount?
The month, yeah. So that discretionary income is going to be 10 or 15%, depending which payment plan you're on. Let's just say 10% for the ease of calculations. It was a late night last night. So 10%, this would be the pay-as-you-earn plan, which unfortunately is going away. So you take 10% of that leftover, say, 150,000-ish. So 10% of that 150,000, you get your $15,000 for an annual payment. You split that into 12, and that's your monthly payment.
Okay. So one step in this process is to determine what someone might qualify for programs? Okay.
Yeah. So if you're at one of these teaching hospitals too, it's always worth looking at, hey, does my hospital qualify, or my employment route in the hospital qualify for public service student loan forgiveness, right? Because that is, you go for the 120 credits, so the 10 years at a qualifying institution. You make sure you're doing your paperwork well, right? Which means certifying your payments annually, and then do that for the 10 years, get as low of a payment as you can, and then the remainder is forgiven at a tax-free level, right? So there's no income tax.
Let me better understand this. There's a possibility that someone could have some of that loan forgiven as well?
Yeah.
Okay.
Some, if not most.
Okay. Wow. All right. So there's a tax strategy involved here, quite a few considerations, but what other strategies impact this type of process that you go through?
So there's a lot of the personal side too, right? And where you want to go with your life, your career, right? If you're coming out of school and say you're one of these higher paid professionals or these more expensive professionals requiring a lot of grad school, and you want to open up your own business, right? It becomes a lot easier to qualify for certain types of debt, right, to open a business when there's a much lower drag on your monthly cash flow. So maybe you have the income to pay on a standard repayment schedule, but you have dreams of opening a practice, whether it's medical, dental, legal, and you need that startup money through a business loan. But you have this massive drag on your monthly cash flow that's you're not going to qualify for either at all or for favorable terms on the loan. So you would look to one of these income-driven plans to say, hey, let's base this off of my AGI or my discretionary income and lower this monthly payment substantially so that everything looks better on the side of the lender. They look at the available free cash flow coming in.
Mm-hmm. Okay. What if, do you ever see any opportunities to have a loan refinanced, or look at a private lender to refinance both any person's private or public debt, student loan debt?
Yeah. There are definitely some great options out there. I can think of one cool company. I don't know if I'm allowed to name drop on here in terms of vendors, but if you ever want to get a hold of a great option, I'd be happy to let any of our listeners know. And it's off the top of my head. And there's a really cool company out there called Juno, right? And they have this really great way of negotiating group rates for different professions, different class years. They work directly with banks to help kind of nail that lower rate. And it's a really cool platform in terms of refinance on the private side. But there's something else to remember here, right? Once you go private, there's no going back. You lose access to all of these income-driven repayment plans. They might be better terms, right, depending on when you took the debt out. Interest rates have come down a little bit, not too much, but a little bit. But depending on when you took the debt out, the interest rate might be a lot better. Maybe you just want to have this all done. You got the cash flow going. You're good. You're set in your professional life. You just want to get on something with a faster turnaround at a lower interest rate. Great. But you need to remember that you lose the protections of being under the federal student loan program. And what do I mean by that? So with private debt, when you miss a payment, you're delinquent. Very quickly after that, you move into default, if not immediately. Depends on the promissory note that you sign when you take out the loan. And this also lends to how scary it is with the amount of delinquencies in federal student loans, because it takes a long time.
It sounds like this can affect your credit and everything.
Oh yeah, you're not paying debt, right? That's always going to affect your credit. But yeah, private loans go into default a lot faster, right? For federal loans, it takes 270 days of non-payment, and there's all kinds of rehabilitation options out there for federal student loans, right? You can go through. They will make you consolidate the loans and jump on an income-driven repayment plan. You make a certain number of payments on time, and it falls off your credit report. If you're in the private side, there's not. You might be able to work with the bank that did the loan, but they have no reason to try to not collect.
Okay.
Right? But yeah, it takes 270 days to enter default on federal loans, right? Delinquency takes.
So that's a very careful consideration.
Yeah.
If you're looking at that.
You're giving up a lot of protection.
What other considerations are there for someone who has a pile of student loan debt? It sounds like, with someone like a doctor, attorney, dentist, or maybe even a teacher, you might want to go through this financial planning process. Even someone who might be wanting to start a business, go through this financial planning process, look for opportunities to lower their adjusted gross income, qualify for some certain eligibility items. What else can someone do, with a pile of student loan debt?
Yeah, so there's some interesting ways of navigating the payment plan specifically, right? I think one of the ones we haven't talked about is the ability to file separately, right? So if you're a married couple, either both high income earners or one high income earner, right? If you've got a pile of student loan debt and your spouse makes a lot more money than you don't want all of that money counted towards that repayment, right? So say, let's just pick an example, right? Teachers married to a high earning corporate lawyer, right? Why they wouldn't just pay off the teacher student loan debt? We'll leave that one off to the side. Everybody's got their reasons, right? But for teachers, right, especially if you're at a qualifying institution, you can either do the public service student loan forgiveness, so PSLF, or there's also something called TSLF, right? And depending, the forgiveness amounts are smaller for TSLF, but it's still an option. And you'll have to forgive me, I didn't dig into the numbers on that one. But yeah, so you can still work towards this loan forgiveness as a teacher. And if you're making a moderate salary as a teacher, right? Say you get your pension credits, you get your 403B, right? And then your health insurance, and you've got all these automatic savings going in pre-tax, falling off your total income for the year. And then you get to your adjusted gross income, maybe you've maxed out your 403B. Say you make $70K a year, you max out your 403B. That amount now, hopefully around the $45,000 mark for AGI on this if you file separately from your spouse, that's what counts towards your loan payment, right? So say your spouse makes $200K, you make $70. Instead of having a $270,000 or after deductions $200,000 total income counting towards this income-driven repayment plan, you file separately, you will lose some ability to take advantage of credits. So it's important to talk to an accountant or a tax professional when you're doing this. But you could lower your student loan payment by maybe $1,000. Yeah. So wow. It's not unsubstantial or insubstantial.
Okay. So basically, one way to show less income if you're married is potentially filing separately. If you're the lower income person of the household with the most debt, that could be more beneficial to your options on that. So that's very interesting.
Or if both of you are high earners, right? So if one's making $200K, the other's making $250, right? Instead of that $450 amount counting towards your student loan payment, you file separately. Now it's just $200, right? Which did the math earlier, and I think it's like a $1,666 a month in student loan payment.
Okay, so this is great. This is great information. Joe, is there anything we haven't touched upon?
I mean, there's probably a lot here, but I think one of the considerations that if you're in the mess and you need help, give us a call. Happy to talk through any of our listener situations with them, figure out if there's a way that we can help them out. If you haven't gotten into this mess yet, right? I think this is something that more needs to be harped on more and more and more. If you have kids getting close to that high school graduation age, or maybe you're one of these kids that is looking at college in the future, right? I think it's important to put this out there as you should underwrite either your kids' loans or your own loans, right? Before taking them out. So what do I mean by that? If you're going to go to school, you want to go to school for something that's going to be profitable on the other side, right? So what's your ROI, your return on investment for going to school and paying X sum for this particular degree, right? So if your earnings potential and no hate to any particular career path out there, if it requires college, it requires college. But I think you need to ask yourself the question, does the school I'm going to make sense for what I want to do? Or does the cost of the school I'm going to make sense for what I want to do, right? So if you're picking a career path that's helping people out, but your income is only going to be $40, $50K a year, it probably doesn't make sense to go to a school that's $50,000, $60,000, $70,000 a year without huge amounts of financial aid. And when I say financial aid, I mean the kind you don't have to pay back.
Yeah, I was thinking, we want to do something, a podcast or an episode for people who are making those choices, which college to choose, which major to choose, but more importantly, how to finance the education. What's the best way to finance it? And so I would look forward to an episode of that with you, if you're interested, of course. And Joe, as Joe mentioned, if you have any questions, feel free to call us. We'd love to hear from you. If your current advisor is not certified in this area, or this is, an area of expertise for them, we'd love to help you. As a matter of fact, better yet, Joe, how can people call you or email you directly?
You want me to drop my phone number?
Absolutely.
Okay, yeah. If you need to get a hold of me, my direct line here at the office is 603-430-3090. And if you wanted to shoot me a note and ask me some questions about student loans and how we can help, I'm probably going to want to set up a time to talk to you. I'm old-fashioned. When my friends text me, I call them. But you can shoot me an email at jneff@measuredwealth.net.
This has been a wealth of information. Joe, before we conclude, right now today is Friday, February 6th. What's your prediction for the Super Bowl?
This is going to be a shocker for you. Ready? I don't know who's playing.
Oh, all right. No. Seattle versus the Patriots.
Oh, I mean, we're in New England. I got to hope the Patriots win, right? But more importantly, I think the first game for Rugby Six Nations was yesterday. So
that's right. Joe is a rugby player. That could be more challenging than being on the football field. But all right. Well, listen, Joe, thank you again for joining me today. And thanks, everyone, for tuning into Financial Futures, a Measured Wealth podcast. If you enjoyed today's episode, be sure to follow or subscribe on your favorite podcast app so you never miss an update. Want to learn more or get in touch? Head over to measuredwealth.net, where you'll find prior episodes, helpful financial planning guides, and more. You can also call us at 603-431-1444 or email at info@measuredwealth.net. That is info@measuredwealth.net. Thanks again for listening, and remember, the future will someday be the present.